this video, I am going to be talking about daily trading bias, finding out whether you should go long or short for your trades, and we are going to use ICT concepts for this. All right, now let's get to it. So what is a daily bias? It's a method that provides a straightforward means of forecasting whether the upcoming day in the market will exhibit a bullish or bearish trend by analyzing the high and low values from the preceding daily candle. The method that I'm going to show you does not require you to see the overall market structure as a whole, but it can help for overall confidence. And let me preface this as well. This goes a lot deeper than what I'm going to cover. There are other people that have covered this in a more extensive manner. I am going to cover it my way, the things that I think are more important overall, and just trying to filter out all the other stuff that are basically fluff to it. I don't think you need to know the overall deeper concept of this, but if you do want to find out more deeper stuff, you can go over to ICT's channel, which I will link down below, and a few others that talk about this. But for now, I will just go over it my way, and hopefully it will give you a better understanding of this type of bias. How can you use this concept to your benefit? You can pair any form of top-down analysis on any time frame below the daily time frame. So if there's a form of analysis that you have that doesn't involve the daily time frame, you can actually pair it with this type of concept, and hopefully it can even give you an overall better bias to finding whether you should go long or short for the day. Secondly, you can use it as a bias for whether you should look for buys or sells only. So if you don't have any other form of analysis, you can actually use this concept as your one and only way or source to find out what you should be doing for the day. Right. Thirdly, finding points of interest that go along with your bias. Now, you can have many points of interest for the day. You can have supply zones or demand zones, but if they don't align with your bias, you could actually be shorting on a day that you shouldn't be shorting, right? So having a concept like this can really help out in terms of finding the right trades in the direction that you want it to go. The fourth thing, you can make up a completely new strategy that solely relies on this concept or pair it with one that already exists. So if you're struggling on where to start for coming up with a new strategy, this is a good place to start. Or if you already have a strategy and it may be a strategy that you're following from another trader, you can also pair this up with it and hopefully give you an extra edge. Lastly, this concept can be applied on intraday timeframes. Now, personally, I don't like using it on intraday timeframes. I'd rather use another form of analysis, but it's up to you. And I think it might be able to give you an extra edge if used correctly. And if you're starting off, I would recommend just use it the way it's going to be shown for you today. Okay? Questions to ask yourself. You can use these questions in the future in case you forget what it is that you're looking for. If you still have questions, even questions that aren't related to what I just explained, you can always put it down in the comment section below, and I will do my best to answer as fast as I can. But I can't promise anything, but I will do my best to definitely give you an answer. Okay, so I'm going to show you some examples. The first example that I'm going to show you is going to be an example of a bullish daily candle or bullish momentum. Okay, so this is going to be very, very simple. Even you're not going to believe how simple this is. So when analyzing the previous daily candle, you're expecting the rest of your trading session or the rest of your day to be whatever that previous candle was. So in this case, we're analyzing this previous daily candle, and the first thing that we notice right off the bat is that it's a bullish candle. And the way that you mark this out is you start from wick to wick, and all you're going to predict is the momentum of the next day. And you should expect the momentum to be what? Bullish. Why? Because the candle is bullish. And as you can see, the next day ended with a bullish daily candle. So how can you use that? Well, easy. You just say, okay, if I'm expecting the rest of the day or the next day to be bullish, then I'm going to only look for buys, right? You can add that to your current strategy or whatever strategy it is that you have or looking at as an extra confluence for your day. Now, something I want to point out for this next example is some people use this middle line as the equilibrium zone or 50% zone. I personally don't really use it. I know some people trade off of this area or the 50% line of the candle when you draw it from wick to wick. I personally don't use it, but you can use it if you want to. I will show you a few examples later on how I personally would trade this type of bias. Okay, now another thing is generally the previous candle high and low wicks are levels seen as previous areas of liquidity, meaning a lot of buying or selling orders are typically clustered around them. Traders often use these levels to anticipate potential price movements. They might see them as points of liquidity or to draw in liquidity, which means manipulating the market to trigger orders, or as indicators of a potential reversal or continuation of a trend. Okay, now as you can see, we have our gaunt box drawn from wick to wick, and the candle did not close underneath the wick or the bearish wick, right? So that means that the momentum is starting to reverse from bearish to bullish. And as you can see in this next example, the next day was bullish or ended with a bullish candle. So quickly, wick to wick, right? We draw a gong box, wick to wick. Price took out the previous daily low, see, took it out, reversed back up, closed inside of the wicks or our box, and then the next day it turned out to be bullish, or we ended up having bullish momentum. Now for our third example, we are going to look at this daily candle that is 3 days before our current trading session. We are going to draw our box from wick to wick, and then we're going to look at our previous daily candle, and as you can see, it closed with the body over the previous or our previous 3rd day's wick, meaning that the next trading session or our current trading session should have bullish momentum and should end with a bullish candle. And as you can see, our day ended with strong bullish momentum. Well, I wouldn't say too strong of a bullish momentum, but you get the point. Now, for our final example, if the overall trend is bullish, then you're more than likely to expect more bullish candles, right? Common sense. So if you zoom out on your daily time frame and you see, okay, we have had a bullish uptrend, which means that we are more than likely to have more bullish days than bearish days. So that means that if you're doing your analysis the way I just showed you, and you see that the next day should have bullish momentum and it aligns with your overall trend, that means that it's even higher likelihood that your longer trades should play out. Okay, so now I'm going to show you some bearish examples. They are generally the same thing as what I've just showed you, but there might be a few tips here and there. Okay, so we are going to look at our previous daily candle, which is bearish, right? And let's just say, to make it easier, our current candle is still forming. So let's say you got something going on right here. Let me change that. Okay, so let's say you got like a whole candle and whatever. That's terrible, but I think you get the point. So the candle for the day is currently forming, and you're looking at our previous daily candle, which is bearish. You draw from wick to wick, and we're expecting to have bearish momentum, and then we're expecting the day to end bearish. And as you can see, that day or our current trading day ended with a bearish candle. Easy and simple for the day. Okay, now for our second bearish example, we're going to look back 3 days. So we have our current day that's forming, right? So let's see here, that, that there, and then, all right, so that day is forming. We go back 1, 2, 3, and we see that our previous daily candle did not close above our bullish daily candle
from the third day, right? So that means that price should now start reversing and going into bearish momentum, and we should start having a bearish trading session and ending it with a bearish daily candle. And as you can see, our day ended bearish with bearish momentum. Now, I want you to also look at this for a moment. The day actually took out the previous daily high of that bearish candle. Now, that means you could have gotten stopped out and then price would have gone back in its original direction, all depending on the time you would have traded. But it still is wise to look for shorts. And another tip is gaps on the daily time frame can also be filled just like when you're scalping. So be very cautious. Let's say the next day bearish because it's trying to fill in this whole gap, and then once the daily candle fills in this gap, then you could start seeing price reverse going back up bullish. Okay, so always remember that, because time is fractal, like I've taught you guys in a previous video. Now for our third example, we're going to again look back 3 days. So let's pretend that we have our current day forming still right somewhere around here. Then we go 1, 2, 3, and then we look at the previous daily candle, which would be this one. See that it closed bearish from the previous daily wick, right? Meaning that our next daily candle should have bearish momentum. So we're using 3 days or a third day or a third previous daily candle to make our analysis even stronger. And as you can see, our current trading session ended with bearish momentum and bearish daily candle. Cool. Now, as our final bearish example, it's the same thing as I showed you with our bullish example. If you zoom out on your daily time frame and you see that the overall market structure is bearish, and you predicting that the next day should have bearish momentum and should end with a bearish candle, that means that your likelihood of your short trades should play out with even more statistical significance, which means that your trades could go even for even longer RR, right? Just another tip to keep in mind. All right, now we're going to do some advanced analysis, and here's a couple of tips that are individual, and I'm going to start off by this one, which says make sure you will zoom in really well when doing this type of analysis. And what I mean is this: when on the daily time frame, make sure you zoom in really closely, because sometimes you can't tell if the candle or the daily candle closed outside of the wick, which is very important for predicting bias, right? You might think it closed inside of the wick, giving you the idea that there should be bearish momentum and that you should be looking for sells instead of longs, which would not have been the case, right? So keep that in mind. Now let's do a quick analysis using the bias method that I just showed you. So as you can see, we have a bearish candle, meaning that the next day should be bearish. As you can see, the next day was bearish, closed outside of the previous day wick, meaning that the next day should be bearish with bearish momentum. And as you can see, the next day was bearish with bearish momentum, but it only took out the previous day wick and did not close outside of that wick, meaning that the next day should have bullish momentum and should end with a bullish candle. As you can see, the next day was bullish with bullish momentum, but it only took out the previous daily high and did not close outside of that candle wick, meaning that the next day should be bearish with bearish momentum. And as you can see, the next day was bearish with bearish momentum and it closed outside of the previous day wick, giving us the bias for our next or current trading session to be bearish. As you can see here, it was bearish. Now, another tip is to keep in mind is that the longer the wicks and or candle, the less likely price will be able to retrace to take out a high or a low. And here is what I mean. So as you can see, price was able to take out the previous daily high from the previous daily candle, but it was so big that it wasn't even able to retrace back to the 50% area. Now, as you can see, the previous daily candle was so big, this candle right here, so big, that the next trading session, which is this candle that I'm referring to, didn't even reach the 50% area, which is why I say I don't even worry about it. So I know some people are going to try to wait for the next day or the next trading session to expect the price to retrace somewhere around here in the middle, but sometimes it doesn't. And if you see this strong daily bullish momentum from the previous daily candle, then you can definitely expect price to not retrace anywhere down here. Okay, so just another tip. If you have an inside bar, that usually means there's no bias, but you can say, okay, it might have closed inside of the candle, but since we ended the day with a bearish candle, I will expect bearish momentum. So I will look for trades that are short only for our next trading session. But be careful because it did not even take out either previous daily high or previous daily low. Okay? Lastly, price won't always retrace to the 50% area, which we just talked about. And I wouldn't personally worry about trading in kill zones when trading with this concept. I know some people are going to try to say that, oh, you should only be pairing this up with kill zones, but I personally don't worry about that. I personally have seen this concept work pretty good without having to trade inside of kill zones. So it's up to you, just in my opinion. Okay, so here are a few examples that I want you to be cautious about. So let's say that you had a strong bullish candle, right? And it closed above the previous daily wick and you're expecting to have bullish momentum. Now you might have had it, but let's say you didn't. It took out the previous daily high and then all of a sudden you have a strong engulfing candle closing below the previous daily bullish candle. Right now, usually that means that it's a sign of reversal in the trend. And same thing here. Let's say you have bearish momentum, right? You have your bearish candle. The next daily candle closed below the previous daily wick. And you're saying, okay, I'm expecting to have bearish momentum and a bearish daily candle. But as you can see, that didn't happen and it completely reversed on you, right? Again, that's usually a sign of a shift in the trend. So let me show you a quick example of what I mean. As you can see here, let me zoom in for you. These are the examples that I was just showing you, or one of the examples I was just showing you. From example 2, as you can see, the bearish trend reached the end of its line and reversed with a strong engulfing candle. And as you can see, the trend shifted from bearish to now bullish. Okay, so that's just something that you should also keep an eye out in case you spot something like this. Okay, so here's a quick real trade example. Let's say that the current candle that we're looking at closed bullish over the previous daily candle. So that means we can expect that the following day to be bullish or have bullish momentum, meaning we should only be looking for buys. You can see for our current trading session, I set up my 5-minute extreme demand zone because there's all this liquidity under here. And we're going to wait for price to come down and touch our zone. Now, as you can see, I dropped down to the 1 minute and waited for price to reach my zone, waited for my favorite candlestick pattern. And then once I entered, I set my TP to target the imbalance under the order block. Now, price touched, you see the candlestick pattern. I entered, put my stop loss right under the demand zone and targeted the gap. You should always, especially as beginners, target for value gaps instead of order blocks or extreme zones or swing points, because price usually looks more towards taking out gaps than swing points, and it's always a safer way to trade and target TPs. Very easy, very simple. Okay, so I want to show you a quick example on market replay. So let's just say you are trading from 8:30 a.m., right? We are going to get our buys for the day. Now, at first, it may look like the price is going downtrend, right? And you might say, oh, I'm going to start looking for shorts. But if we use our daily bias, we can clearly see that we have bullish momentum. Why? Because this candle, our previous daily candle, closed above our previous third candle. So what we're going to do is now draw wick from wick, right? And we should expect bullish momentum, which we have, which means we should only be looking for buys for our current trading session. So let's just say you trade on the 5-minute. We're going to drop down and we are going to use fair value gaps, or you could use supply and demand. which in this case we could say, okay, this could be a extreme area with all this liquidity. So we can mark this area off right here, right? I would say this all the way up here. And we're going to change this as a zone. Now, what we are going to wait is for either a candlestick pattern, or if you want to be safer, we can wait for a market structure shift. In other words, a break of this fractal high right here. Okay, it taps in, bearish. Okay, it's eating in. All right, this is no longer valid. Looking for buys. Looks like it's gonna just target this whole gap maybe. Okay, so strong bullish candle, took some of this gap out. I want to be safe about this. I'm going to wait for this fractal high to get broken. Okay, it got broken. Now you could either wait for price to retrace down to this fair value gap, but since the momentum is so strong, I think I'm just going to enter from here. And I'm going to set my stop loss just under here. And then we're going to go for a 1 to 2. And let's let price play out. Okay, perfect. Our 1 to 2 got hit. Now I'm just going to go for a 1 to 5. And see if I get touched. I'm not going to move my stop loss to break even just for this example. Usually, if you know what you're doing, you don't have to. And bam, our 1 to 5 gets hit. Now, as you can see, you don't have to always have order blocks. You could just use fair value gaps and a market structure shift. Enter the break of that market structure shift, and you have your trade for the day. A quick 1 to 5. Now, just a reminder, this is not fail-proof, and no other form of analysis is either. You can look up any other YouTube videos on daily bias, the advanced form of daily bias, whatever kind of bias video that you want to look at. Nothing is foolproof, okay? So don't ever think that there is some kind of holy grail to this bias thing, because there isn't. I just want you to be realistic. I want you to keep that in mind. I don't want you to have that kind of pressure on you, thinking there is a better form of daily bias than another, because the simple fact of the matter is that trading is subjective, like I always say. As for tools that you can use, here are the indicators that I would use and that I still use when trading in this kind of concept. So I use my gone box. Here are the settings for it. The fair value gap indicator that I used earlier, the zigzag indicator, or the higher high, higher low indicator that you saw earlier in the examples, the fractals indicator, and there is also a daily bias indicator that you can use if you don't want to mark them out yourself. Real easy stuff to use. They're all free, and if you can't add all of these onto your TradingView account because you have a smaller plan, then the best thing that I can recommend to you is to either upgrade or just use one by one. And before ending this video, I want to give a quick shout out to ICT. I have linked his YouTube channel in this presentation, as well as Fractal Flow and Mulhelm Trading. Their videos have been really educational in terms of figuring this whole presentation out and taking their ideas and putting it in a way that you guys can understand it in a way that I thought was more useful. If you do want to check out these guys' videos, I highly recommend you follow them and give them a like, subscribe to their channels, and yeah, definitely recommend these guys to you. Now, lastly, thank you for looking at my video. Thank you so much for sticking around to the end. I hope you found some value in this video. Hopefully it can help you guys find your bias if that's what you're struggling with. And if you have any questions, please leave them down in the comments below. Or if you have found it to be useful, please let me know in the comments. It's a really great motivator for me. And I'm going to leave you with this quick verse, which is Proverbs chapter 3, 5 through 6. Which is, trust in the Lord with all your heart and lean not on your own understanding. In all your ways submit to him, and he will make your path straight. This verse emphasizes the importance of trusting in a higher power for guidance and surrendering one's plans to receive divine direction in life. With that being said, thank you guys. Hope you have a wonderful trading session, and God bless.